You've finally saved up a real pool of capital, and it's time to put that money to work in a long-term growth strategy. You do your homework, and every finance forum points you toward QQQ. But then a friend mentions they bought a different fund around the same time, and their historical returns are beating yours by a wide margin. That usually leads directly to a showdown between the three heavyweights of the growth ETF space: QQQ, VGT, and SCHG. Take a look at this chart comparing the trailing 10-year returns for these funds. VGT sits at roughly 24% annualized, well ahead of QQQ at 20%, and SCHG near 18%. Looking at this data, the immediate instinct is to dump everything into the highest performer. The problem is assuming that a specific 10-year historical line will just neatly replicate itself over the next decade. The past 10 years have represented the absolute strongest sustained run for the pure technology sector in modern market history. That specific environment heavily skews these baseline numbers. We aren't going to try to chase past momentum today. We are going to unpack the structural mechanics of each ETF so you can clearly align your money with your specific tolerance for risk. Let's map how each fund balances sector concentration against its cost. This chart sets tech concentration on the y-axis and cost on the x-axis. Vanguard's VGT lands right here, at the extreme upper edge for concentration, with a moderate cost. Roughly 98% of this portfolio is dedicated entirely to technology, dominated heavily by positions in Apple, Microsoft, and NVIDIA. By stripping away other sectors, VGT captures every ounce of upside when technology companies go on a multi-year run. But a near 100% tech allocation means you hold virtually zero healthcare or consumer staples. You have no buffer if that single industry stalls. During the early 2000s, the tech sector drastically underperformed the broader market for years. A highly concentrated fund has nowhere to hide. It absorbs the entirety of that sector-specific hit. VGT is a high-reward vehicle strictly for those willing to accept steep market drawdowns without the safety net of broad diversification. Now we turn to QQQ, the most recognizable name in the space. While it's the standard for Nasdaq exposure, long-term investors should look closely at a specific variation called QQQM. While the original QQQ charges 0.18%, its twin, QQQM, tracks the exact same companies for a lower 0.15% fee, a structure built for buy-and-hold investors. On our quadrant chart, QQQM plots lower on tech concentration, sitting further left reflecting higher comparative cost. While leaning heavily into technology at 56%, the fund intentionally preserves 44% for communication, consumer discretionary, and healthcare stocks. That structure provides steady, innovation-driven growth while maintaining enough breadth to survive severe market contractions, like the 2008 financial crisis. The trade-off is that when pure technology stocks are scaling aggressively, that 44% non-tech buffer acts as an unavoidable drag on your total return. QQQM serves as the compromise play. You sacrifice absolute peak performance in exchange for a portfolio built to survive mixed market cycles. Finally, we have SCHG. This is the consistently underrated alternative that prioritizes methodology and extreme cost efficiency. SCHG drops to the absolute bottom right of our matrix, with the lowest tech concentration and cost. A strict 6-factor financial screen filters it down to 230 stocks, creating the most diversified sector exposure among these three options. The primary driver here is the microscopic 0.04% expense ratio. That is less than a quarter of the fee you pay for QQQ. This graph tracks the exact impact of those fees. Over a 30-year horizon, minimizing that expense ratio keeps thousands of extra dollars compounding inside your portfolio. Its disciplined diversification and lower tech weight guarantee it will trail highly concentrated funds during runaway tech rallies. SCHG is the definitive vehicle for cost-conscious optimizers who prioritize downside cushioning over chasing absolute market momentum. Asking which of these three funds is the best is a flawed question. Ultimately, successful investing requires you to structurally align a fund's specific mechanics directly with your own personal market beliefs. We can map out exactly where you fit. This decision flowchart starts with a single question: what is your primary investment belief? If you believe artificial intelligence and cloud computing will absolutely dominate the next decade, and you can stomach severe volatility along the way. VGT is your match. If you want tech-leaning growth but demand a proven safety net across other major sectors, QQQM provides that optimal middle ground. Or if your absolute priority is minimizing manager fees and buffering your portfolio against steep market drops, SCHG delivers maximum cost efficiency and broad diversification. The strategy that actually builds wealth over 30 years is the one you understand well enough to hold when the rest of the market begins to panic.